Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I am your host Anurag Bansal, and in today's episode we'll talk about 5 big stories. We'll first talk about what is happening with WazirX after the recent hack that they underwent. Second, we'll talk about how Adani and Birla are now taking each other head on. Third, we'll talk about how SBI Cards earnings have really gone down. Fourth, we look at how Indigo has really captured the Indian aviation market and what is in the aviation sector for us. And finally, fifth, we look at yet another change in gold, this time with sovereign gold bonds. By the way, this show is also available on Spotify, Apple Music, YouTube Music, and also available as a video on YouTube. You can choose wherever you want to consume your content. We also send out a daily brief newsletter every morning which summarizes everything we discuss in a small newsletter format. So if you are interested, consider subscribing via Substack. So let's begin with today's episode. Last week I'd spoken about the massive hack of Indian crypto exchange WazirX, in which hackers stole over 1800 crore rupees. This, by the way, is about 45% of all assets on this exchange. Hackers managed to steal over $230 million worth of crypto assets from the exchange. This breach hit one of WazirX's crypto wallets on the Ethereum blockchain. Now, as damage control, WazirX has acknowledged this issue and has temporarily suspended all withdrawals to protect its users' assets. Now, you would naturally assume that since this hack was not your fault, you would get back all your money from the exchange, right? Well, that's not quite the case. WazirX is instead thinking of distributing all these losses to all its users regardless of whether or not they were affected by the hack. Their blog says, and I quote, "a fair and transparent socialized loss strategy to distribute the impact across all users equitably." Now, it's a little funny that a crypto platform is using the word socialize when the entire reputation of crypto is about being anti-government and decentralized. WazirX is now giving its users two options. First is to continue trading on the platform with no withdrawals but a high priority for any recovered assets. In this option, users will have a low priority for recovered assets. Essentially, WazirX is redistributing the savings of users among people who lost their savings to scams to ensure equality. Now, that is like a bank which is trying to use your savings to pay another user to offset their losses. Now, considering this is a stock market related show, you might be wondering, could something similar happen to stockbrokers as well? To understand this, I will need you to understand how crypto exchanges are fundamentally different from stock exchanges. See, when you trade on a crypto exchange, the exchange holds all your assets in a hot wallet. If this wallet gets hacked, you lose all your assets, but you can protect yourself by moving your tokens to a cold wallet, which is an offline wallet. But that is not what most people do because it is complicated. Stock exchanges work very differently. When you buy stocks, bonds, ETFs, etc., the securities are not stored within the exchange but in your own demat accounts, which is like a wallet itself. Now, these demat accounts are maintained by two authorized depositories, CDSL and NSDL. The only way your demat account can be hacked is if you willingly share the password to your broking account or if CDSL and NSDL get hacked. So that largely means that a similar problem happening with your stockbroker or stock exchange is far less likely as compared to what it could be when you're trading in crypto. Now, moving on to the next story, let's talk about how Ultratech Cement and India Cement are merging into one entity. Ultratech Cement, which is India's largest cement maker and the world's third largest if you exclude China, is buying a controlling stake in India Cements, which is a major player in South India. Here is what is happening in simple words. See, Ultratech is buying about 32% stake in India Cements from the promoters for over 3,900 crore rupees. They had already bought a 23% stake back in June, but after this deal, they will now own about 55% of India Cements as a company. This acquisition is a big deal because it will make Ultratech Cement a dominant player in the fragmented South Indian market. It will increase its market share from 12% to a 23% in this region. Now, this is not something new. The Indian cement industry has been consolidating for over a decade now. In the last 10 years or so, we've seen some high-profile deals happening here. First is Nirmal Limited acquiring Lafarge India for 9,400 crores. Second was when Adani bought Ambuja Cement for over 80,000 crore rupees. Now, this latest move puts the Birlas, who own Ultratech, in direct competition with the Adanis, who own Ambuja Cement, ACC, and a few others. Adani, for your context, is currently the second largest player in the cement market of India. But why is Ultratech making this move, you might be wondering? Well, a few reasons. First, India is still developing as a nation. We need massive investments in infrastructure, roads, bridges, houses, industries, etc., and they all need cement. Second, the infrastructure push is one of the big reasons why India has been one of the fastest growing economies in the world right now. In fact, India's GDP growth over the last 4 to 5 years has primarily been driven by government investments. Third, the recent budget plans to invest 10 lakh crore rupees to provide housing for 1 crore urban poor and middle class families under the PM Awas Yojana Urban 2.0. The cement industry is highly competitive and fragmented with many smaller firms. By consolidating these smaller firms, Ultratech can improve its operational efficiency and become an even bigger player in this industry. Now moving on to the next story of the day, SBI Card, which is India's second largest credit card issuer after HDFC Bank, recently announced their results, and their results were very disappointing to say the least, but they still had several interesting trends. Their profits are flat, there is no growth quarter on quarter or year on year. They have also been steadily losing market share over the last couple of years or so. Second, corporate spends have taken a hit thanks to RBI's regulatory crackdown. They have banned certain types of credit card spends in the B2B space. On the flip side, retail spends are growing at a healthy pace. Third, non-performing assets or NPAs are on the rise for SBI cards. Both stage 2 and stage 3 loans are increasing. I'll break that down for you if you don't know. Stage 1 loans are overdue by up to 30 days. Stage 2 loans are overdue by 31 to 89 days. Stage 3 loans are overdue by more than 90 days. This means that people aren't just missing their credit card payments, many seem to have also borrowed much more than what they can handle or pay back. SBI Cards is taking action though. They have reduced limits on 5 lakh credit cards this quarter after cutting limits on 15 lakh cards in the previous quarter. But here's the thing, this rising bad loan trend is just not an SBI Cards problem. It is happening across the industry, especially in the unsecured retail lending segment. I'll throw some more interesting tidbits for you from a Kotak research report that came out recently. Out of all the money people owe SBI Cards, 62% is earning interest. That is good news for SBI Cards because they are making money off those outstanding balances. Second, the share of new accounts from salaried individuals dropped from 79% in 2021 to 68%. Meanwhile, the share of self-employed individuals has gone up from 21% to 32%. The share of cards in tier 3 cities has exploded as well. It was around 10% at the end of 2021 and now it is at about 30%, which is crazy. Moving on to the fourth story of the day, let's talk about Interglobe Aviation or Indigo's recently announced quarterly results. See, the reason why I'm talking about this is because Indigo controls more than 60% of India's domestic aviation market, so its results and numbers usually provide great insights into the country's overall aviation industry. See, according to the quarter's results of Indigo, their revenues increased by 18%, but their profits fell down by 12%. But let's put that aside because the focus of this show is not just on the numbers, but going a level deeper and exploring interesting insights about the overall industry. So let me break things down for you. Firstly, it is important to understand that the airline industry generally uses a metric called passenger revenue per available seat kilometer or PRASK in order to measure efficiency. Now, this number is calculated by a combination of total revenue from passengers, the number of seats, and the total kilometers that they travel. Indigo's PRASK number this quarter was 4.54 rupees, and this was roughly the same as last year. Why I am saying this is because Indigo's PRASK number or PRASK number has been equal to or even better than the top domestic airlines globally, which is absolutely crazy. Also, Indigo's earnings per kilometer and per passenger were 1.3% higher than the previous quarter. This means Indigo, which leads the Indian aviation market, has been able to keep its revenue stable despite the overall market being relatively unstable due to monsoons, etc. Now, Indigo has also been able to make more money per ticket than its previous quarter, which means they are able to capitalize very well on their leading market position and operational efficiencies. But even though Indigo is so big, India's overall aviation market as a whole is still in very early stages. I'll zoom out a little bit here and give you a couple of insights to give you a sense of where we are in India as an aviation market today. To begin with, our aviation market is still very tiny as compared to our population. We have only about 500 commercial planes for a massive 150 crore population size. In comparison, the US has over 10,000 planes for just 35 crore people. India has also less than 150 airports, while a country like the US has over 5,000 airports for a much smaller population. Also, according to Aditya Ghosh, who's the ex-CEO of Indigo, the number of people who travel by train in 1 week in India is equal to the number of people who travel by air air in 1 year in India. So it's not like our population does not travel, they just don't travel by air. Next, the aviation market is still centered around India's major cities like Delhi, Mumbai and Bangalore. Even after having multiple terminals, these cities are struggling with capacity problems. And on the other hand, there are still some cities without good airport connectivity in India. But that said, the Indian aviation industry is going through a definite growth phase. If reports are to be believed, we will be adding about 2,700 new airplanes in the next 20 years alone. The projection is that if everything goes well, India will be in the world's top 3 air passenger markets by the year 2041. By the way, even though India's aviation market is far behind the US, Indigo is at par with US aviation companies when it comes to the numbers. Indigo's market capitalization or market cap is similar or even better in some cases than some of the top domestic airline operators worldwide. Indigo is also a profitable airline company, while on the other hand, most other airlines globally are still burning money. But when it comes to a country as large as India, Indigo alone can definitely not carry all of the country's passenger load. As India gets richer over time, aviation market is one market that is definitely going to grow. So if India truly has to become an important aviation market, multiple airlines must do well. And therefore this industry will be very interesting to keep a watch on for the future. Now moving on to the last story of the day, we'll talk about how there is another change in gold now, but this time it is related to SGBs or sovereign gold bonds. See, the government might soon make a big change to its plans of issuing sovereign gold bonds or SGBs in FY 2025. I'll tell you about it with some background context because it is important to know why SGBs were introduced in the first place in India. See, India imports large amounts of gold from the rest of the world. The thing about physical gold is that it does not generate any income or contribute to the economy. Instead, it puts more pressure on the rupee and our current account deficit because we are buying so much from the outside. According to estimates, Indians buy as much as 700 tons of physical gold bars and coins every single year, and we also import roughly 800 to 1000 tons every year. So in 2015, the government introduced sovereign gold bonds or SGBs as a digital form of gold to reduce the Indian fascination with physical gold. The government hoped that some people would stop buying physical gold and instead buy SGBs. Now this would reduce imports and the government and the RBI would not have to worry so much about the growing current account deficit of the country. Hence, it was very important for the government to issue SGBs at regular intervals, otherwise people would go back to buying jewelry and gold bars, which would again increase imports. But times have changed and now things seem to be getting better regarding our current account deficit and inflation as well. Our country seems to be okay even if gold imports increase slightly now, and that is also why the government had reduced the import duty on gold in the previous budget, which is something that we also spoke about in our July 25th episode. Now there is speculation that the government will reduce the number of SGBs issued in this financial year. As per speculations, the government will cut its target for issuing SGBs in FY 2025 by as much as 38%. The new target set by the government is 18,500 crore rupees of gold bonds in this financial year. Now this is down from about 29,000 crores in the interim budget and 26,000 crores in the revised estimate for 2023-2024. For your context, since 2015, the RBI on the behalf of the government has issued over 70,000 crore rupees worth of SGBs, and out of this, around 27,000 crores worth of SGBs were issued in FY 2024 alone. This is because gold prices have been steadily making new highs in the last year or so and people want to increasingly buy them. Now for the broader economy, this reduction will obviously have some effects. I don't have definite answers for you, but I have some questions. First, will the reduction in the issue of SGBs increase our imports? Second, will people look for SGB alternatives like digital gold and gold ETFs even though they are not as attractive as SGBs? Well, only time will tell us. Well, that's all the news I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.